I might just start by just talking for 30 seconds about how I got into pricing and why I'm so passionate about it. As Ivan's already sort of alluded to, I've got quite an analytical background. So I came up through commercial finance, decision analysis, margin optimization, and then gradually moved more towards sort of strategic work with corporates. About 15 years ago, that was when I sort of embarked on my first sort of pricing experience. And what really drew me to it was not only the analytical side, but the sort of blend of art and science. So the art part being the psychology of pricing and consumer behavior. And, there's a great deal of marketing components in there as well, such as customer segmentation, buyer persona work, understanding your ideal customer profile, and then combining that with the data and insights and unpacking it and doing the analytics to actually put some rigor and take a structured approach to understanding willingness to pay, the competitive landscape, etc. So I guess it's a very sort of varied, and it's got a lot of flavor to it. And as a result, you get a lot of differing opinions when it comes, and fairly strong. So I'm looking forward to a thought-provoking discussion. It tends to be quite an emotive topic, which is great. I love to be challenged. So without further ado, let's jump into it. So in this session, we'll take a brief look at how inflation can impact upon SaaS companies and sort of well diversified subscription companies in general. Quick caveat, there's a lot of references to SaaS within this presentation. However, 80% of the content relates to any well-differentiated subscription business that's focused on growth. And I'll demonstrate how monetization is such an important growth lever. So we'll explore how a lack of monetization is limiting cash flow growth and valuation potential. I will introduce 4 levels of pricing power that exist within any market and a monetization and growth framework that will level up your pricing power, fueling the next stage of growth for your SaaS company. Finally, we will touch upon how differentiated value selling is fundamental to improving pricing power. But before we get into that, let's just spend a few minutes just talking through some of the major growth challenges facing companies in 2022. With inflation levels at a 32-year high in New Zealand and Australia, sales, marketing, and product development costs have all significantly increased. Same goes for funding costs with increases to interest rates. And the proliferation of freemium offers has also led to customers expecting more value for paying less. Proving out value, targeted acquisition, differentiating features, and positioning your proposition in a way that scales with your customers has never been more critical. SaaS in 2022 is a far more competitive space than it was a few years ago, given the low barriers to entry, and the key to success is differentiating your offer within your target market. The gold rush is over. Finding the blue ocean in a sea of red is where the sustainable growth opportunity lies. As you'll see from that statistic there at the bottom of the slide, 82% of small businesses fail because of cash flow problems. And SaaS companies are no exception. Growth needs to be profitable in order to remain sustainable. Gone are the days where you can just expect to rely upon acquisition at all costs. So that's a bit of a segue into this here. Customer acquisition costs, as you can see, have increased significantly, and nearly 70% over the 5-year period. And this trend really speaks to the necessity of focusing on targeted acquisition based on your ideal customer profile, but also a shift in focus towards retention and monetization, not just acquisition at all costs. Supporting the observation from 2 slides ago regarding the demonetization of the SaaS space due to freemium offers and intense competition, this graph really shows the extent to which these factors impact on customers' willingness to pay in 2022. This data shows an almost 4-fold decline over the past 4 years in willingness to pay, which illustrates the importance of a needs-based analysis, a deep understanding of buyer personas, and subsequent value creation. So let's consider inflation. It's a hot topic right now, and no doubt we've all been subjected to news about inflation recently, with CPI in New Zealand having reached a 32-year high with a 7.3% increase year on year over the past quarter, which is, I believe, just dropped back slightly in the news that we've just seen. However, it's still very, very high. But what does it mean for SaaS companies? While SaaS businesses do not have substantial supply chain costs and cost of goods sold in the same way that traditional businesses do, they are still susceptible to wage increases, product development costs, and sales and marketing costs, all of which are increasing, particularly in light of current labor shortages. This leads to a margin squeeze and pressure on cash flow, hindering scalability. It is totally acceptable to raise prices more than once a year, so long as it aligns with your customer's perception of value. In fact, SaaS companies that I have seen with the most success in revenue and adoption review their pricing at least on a quarterly basis, making strategic changes every 6 to 9 months. In the last slide, we briefly touched on how monetization makes businesses more resilient to inflation, sustainably generating more cash flow to fuel the next stage of growth. But it is also an important consideration in creating funding opportunities. There are 3 recognized growth levers that can improve profitability: acquisition, retention, and monetization. But which is the most effective growth lever? Profitwell conducted a study of 512 SaaS companies to see the impact on profitability of improving each growth lever. And the results showed that monetization has 4 times more impact on the bottom line compared to acquisition, and twice more impact than retention even. So does that mean that SaaS companies are heavily focused on monetization today? Unfortunately, quite the opposite. In a further study conducted by Profitwell, they reviewed 10,000 growth-related articles to see how many related to monetization versus acquisition and retention. And they found that 7 times more articles were about acquisition than monetization. This really speaks to the lack of expertise and focus on monetization at an executive level, which presents a huge missed opportunity for SaaS companies that wish to improve their cash flow performance. So what do I mean by monetization? This is the mechanism by which you generate revenue from your value proposition. And pricing is one of several key components of the monetization process, which I'll circle back to later on. So let's take a moment to see how much money is being left on the table. In a study conducted by Blue Ridge Partners across US and Europe, they found that 85% of SaaS companies did not raise prices during the recent inflationary spike that began late 2020. Of the 15% that did raise prices, the average increase was only 7.6%, far short of the 15+% increase that high-performing SaaS companies were able to implement based on the value that they're delivering through their proposition. The number one reason why SaaS companies have not raised prices over the past several months was a general lack of pricing expertise and monetization focus at an executive level. In fact, and this is really, really shocking, research shows that most companies spend less than 10 hours per year on pricing, resorting to strategies like guessing and relying on discounts rather than pricing based on value. For SaaS companies, this statistic is even worse. I believe it's 6 hours, I read 6 hours in the whole entire lifetime of their business that they spend on this business critical and profit critical growth driver. So continuous price optimization can result in 2 to 4 times higher ARPU. Another fun fact, SaaS companies need an LTV to CAC ratio of at least 3 to 1 to run successfully. But with continual price optimization, you can push that ratio to 11 to 1 and beyond. However, price optimization does not simply mean raising prices uniformly. If it were that simple, then every company would do it and double their revenue overnight. It is about evaluating the pricing potential across all product sets, geographic segments, and buyer personas. When you apply rigor and take a considered approach to pricing and packaging, combined with a great communication strategy, fear of losing customers due to charging higher prices is no longer a concern. One of the common objections to price increases for businesses is a fear of losing customers. But how justified is this? So again, following on from that Blue Ridge Partners research, they looked at the customer sentiment or the customer negative reaction to raising prices all the way from 3% through to 15%. And as you can see, even at the higher end, the customer negative reaction is still relatively low, with five being no reaction and 1 being a huge reaction, and they lose lots of customers that churn. It's relatively low. And essentially what this talks to is that raising prices just captures some of the value being left on the table, the money being left on the table. It just closes the gap. Now, some customers may even have concerns about the sustainability of your business if you are charging way below the value that you deliver. And it's not unreasonable for them to take this view, given that underpricing impacts on a tech company's ability to raise capital and reinvest into improving the value proposition. Another important point is that pricing too low impacts how your potential customers perceive the value of your product or service. This is also known as price signaling. Customers of B2B SaaS companies in particular invest in long-term relationships and often pay initial setup or integration costs. So they will expect you to charge a fair price to remain a viable business. If you are easily winning customers with little or no pushback, it is likely a sign you're leaving money on the table and need to review your pricing. It is healthy to lose some price-sensitive customers so that you can focus resources on attracting and retaining those customers that truly value your proposition and are willing to pay a premium for it. The principle of self-selection is key when it comes to positioning and pricing strategy. So let's take a look at an example to illustrate some of the key takeaways from the past few slides. Like many SaaS startups, Stormpulse had adopted a product-led growth strategy with a freemium offering that attracted large numbers of B2C customers. But despite this, Stormpulse was still struggling to pay the bills and continue to support their customers due to a lack of paid conversion. In 2021, Stormpulse took a deep look at the value delivered, customer acquisition costs, and support costs across their customer segments, from low end to high end. And they discovered that the low-end B2C customers were expecting high levels of support, but were not upgrading, not converting from freemium, and not generating any revenue for the business. By pricing to accommodate low-end customers, Stormpulse were leaving massive amounts of money on the table and putting their business and ability to service high-end customers in jeopardy. Following a review of segment value, Stormpulse decided to raise prices tenfold, from $49 per year to $499 per year, and remove their freemium offering. They also introduced 2 more premium packages at higher price points. The result was that Stormpulse were able to focus on those customers, mainly enterprise customers, that their SaaS product delivers significant value to, and that would be happy to pay for that value. As a result, Stormpulse made more money with fewer customers, and less than a year later, they were profitable. Monetization is the true test of the strength of a value proposition. There are many examples of SaaS heavyweights that struggle to get paid conversion from freemium beyond even 5 to 10%. 2 notable examples would be Dropbox and Evernote, whose conversion rates are 5% and 7% respectively. So consider how high the freemium mountain is to climb over, and who you will attract before introducing it to all your customers. Software is an experience-driven product, but you can work around this by offering free trials rather than freemium. One of the major contributors to successful monetization is the level of pricing power that exists within an organization. Pricing power is defined as a company's ability to raise prices without losing customers or seeing a drop in demand. Or put another way, a company's ability to charge the price that it deserves for the value that it delivers. Pricing power enables you to generate more revenue, which in turn drives greater profitability and cash flow, and is also one of the most important considerations when it comes to funding and valuations when talking to private equity or venture capital. In every market, we can identify 4 levels of pricing power: cost chaser, market pricer, value conqueror, and price optimizer. Perhaps you're a cost chaser. You're working out your costs and adding a margin. If you're a market pricer, then you would look at your competitors' prices and set yours similarly. Maybe you're just going with your gut. Both of these approaches can be profitable, but both leave money on the table, given that neither of them consider differential value or willingness to pay. The most profitable SaaS companies strive to become value conquerors and price optimizers that put customer value at the forefront, are driven by data, and match your customers' purchasing and usage habits. Now, operating at a level 3 or 4 does not mean that you're ignoring costs and competitor pricing, but rather that these are a benchmark for prices that you can set based on segment value and willingness to pay. To achieve the coveted status of price optimizer, SaaS companies will have incorporated everything from previous levels, as well as prices, implementing continuous price optimization processes, prices that vary by segment, pricing engines that drive automation, and adopted differentiated value selling, which we'll circle back to shortly. At this point, I would invite each of you to take a moment to evaluate where you might sit on this pricing power scale.
And put that in the chat.
Yes, please. Yeah. I would like to think that there are very few SaaS companies that operate at a cost chaser level. This is so ineffective because your customers do not care about your costs. They're internal to you. They only care about the value that you generate for your business. However, many SaaS companies often get stuck at market pricer level and struggle to move to value conqueror and beyond without seeking pricing expertise. This is a monetization and growth framework that successful SaaS companies adopt to realize their pricing power and fuel the next stage of growth. In simple terms, it is made up of 3 core strategies: packaging, which is what your customers get; positioning, which is why your customers pay; and pricing, which is what your customers pay. There are 4 key pillars of the process that we take all of our SaaS clients through to level up their pricing power. The first critical step in this process is to identify target segments and buyer personas based on product use cases. Gaining a deep understanding of this will inform your packaging strategy and feature differentiation. There are 2 forms of SaaS monetization, and I would recommend leveraging both: feature differentiation and value metrics. Companies that adopt value metric pricing grow twice as fast as those who rely solely on feature differentiation. So just to define that a little bit further, feature differentiation is the way in which you package features together based on relative importance to your buyer personas. And we've got Brian. Do we have Brian Fine with us today?
Yes, we do.
Yeah. So the work that he does is absolutely critical to this.
So he does research, and it's quite interesting. He spoke a few months ago, and I'll share that playlist. And he said pricing is important, which is, you know, I suppose for FMCG thing, for FMCG.
But the work that he does provides insights around the relative importance of those features. It's so critical to this process. Yes. So picking the right value metric can make or break your monetization strategy. A value metric is the mechanism by which you generate revenue from and deliver value to your customers. Think of it as a proxy between your feature sets and value delivered. Value metrics can be user-based, such as Salesforce, or usage-based, such as Wistia, who charge based on the number of videos, or HubSpot, who charge based on the number of contacts. Many SaaS companies adopt user-based pricing, and this is the most simplistic approach, but it is often not the best value metric. Apply this test. Does it align with your customer's needs? Does it scale with your customer? It should not discourage greater use of the product, and it should be easy for the customer to understand and measure. Slack's approach to charging based on active users is a great example of this, as it de-risks adoption for its customers. Most companies do not take the time to really understand their buyer personas, and how willingness to pay can vary across the different segments. Your packaging strategy should cater for usage patterns and budgets across your target buyer personas and enable them to self-select based on their preferred package based on their needs. Okay, so create a pathway to upgrading and consider what compelling event would trigger that desire to upgrade for each buyer persona. Try wherever possible to quantify value in terms of customer ROI. This could be the amount of revenue generated, or it could be cost savings, or it could be risk reduction. And it could be something more qualitative, such as emotional value or relationship value. But these are very difficult to measure. So wherever possible, try to quantify the value. However, keep in mind that not all customers derive the same amount of value from your solutions, and your larger customers are undoubtedly deriving more value from the product relative to customers that sit on freemium. Low value customers can often suck up huge amounts of resource at the expense of strategic customers, as we saw in the Storm Pulse example. A common misconception is that simply listing features on a product or pricing page is sufficient for customers to self-select a package based that's designed for their buyer persona. It cannot be assumed that customers will understand the benefits and select the package that is right for them without articulation of value and the ROI each solution delivers. Perceived value is the only value that matters when it comes to willingness to pay for goods and services. The most efficient way to improve perceived value is through effective value messaging, customer interactions, and value selling, which we'll be discussing shortly. This is ultimately what will differentiate you from your competitors and convince your customers that this is the only solution that meets their specific set of needs. When communicating price increases, always lead with value and state product improvements up front. Try to build a cadence of regular annual price reviews, which conditions customers to expect it. There's this concept called the principle of loss aversion, which is where a potential loss seems more painful than a potential gain seems rewarding. And so if you've ever sort of like been into like a Mercedes or a showroom or something like that, they'll start by showing you their absolute best model with all the kind of best features and, you know, the heated seats and this and that, and then they'll gradually sort of show you models that take away a lot of those value adds, and that the pain that you feel from taking those features away is far greater than showing it to you the other way around. Don't know if you guys have experienced that, but anyway, I digress. So value, I'd like to take a moment just to elaborate on differentiated value selling, as it is such an important aspect of delivering pricing power effectively. There are three things that you need to know about differentiated value selling. Reframe customer conversations to establish the pain point, problem, or opportunity before introducing the value proposition. Your sales professionals are your value champions, and they should ask the prospect strategic questions to quantify the value of your solution to them. Position your solution as the only one that meets the specific needs of the prospect, and only discuss price once they're convinced on the substantial value of it. Price then becomes a formality and almost irrelevant, as perceived value far outweighs the cost of the solution. The numbers speak for themselves, with value selling leading to a 70% improvement in net new account close rates based on a decision-linked survey of 203 software sales leaders. So back to the monetization framework, the fourth pillar is around capturing value through your pricing strategy. Value-based pricing is the process of regularly iterating prices to progressively get closer to willingness to pay. Think about it like your North Star that every company should strive for, but it's a destination that you can never quite reach. Willingness to pay is determined by the perceived value relative to alternatives, which will vary by customer and shift dynamically over time. Therefore, setting a pricing strategy is not a set and forget activity, and needs to be regularly reviewed and iterated in line with perceived value and market dynamics. Perceived value can be improved through positioning, as discussed on the previous slide. But rather than guessing, a more scientific and accurate methodology to measure willingness to pay is by conducting pricing experiments and studies across subsets of your customer base and target market. I won't go into the technicalities of the research options in this presentation, but feel free to reach out to me later if you're interested to know more. A governance framework and formation of a pricing committee ensures that discipline around discounting is maintained, protecting profit margins whilst enabling agile selling. So in summary, I would like to talk through the specific challenges that are addressed by effective monetization. Inflation leads to a margin squeeze in the absence of a value-based pricing strategy, and poor monetization can limit funding options and valuation potential. Focusing on acquisition at all costs is a risky strategy in this increasingly competitive space. SaaS companies need to adopt a balanced approach, and this is key, a balanced approach to growth in order to be successful in the long term. Fear of losing customers is often driven by a lack of understanding of segment value, and in most cases not justified, given that a significant amount of money is being left on the table. Lack of focus on your target market leads to diluted yields and poor monetization outcomes. To conclude, it is not about getting to the perfect price point that every customer is willing to pay. The biggest challenge for most businesses is that they do not know how to measure how much money is being left on the table through underpricing. But putting continuous price optimization processes in place gets you closer to closing that gap. So thanks for listening.